Hey, Adam Hoeksema here from ProjectionHub, and in this video I'm going to walk you through the process of how to sell a portion of your business. In particular, I'm going to be kind of walking you through some unique nuances when you are selling a portion of a business where the full business is on one tax return and you want to sell a division or a location, and it represents a portion of the revenue and a portion of the expenses on your tax return. And how does a lender look at that? So typically, the buyer probably is going to be using an SBA loan or some sort of debt financing, and the lender in their underwriting process is going to need to underwrite based on tax returns. So they're going to take the tax returns for the entire business, but that doesn't really represent the portion that they're carving out, right? So this is called a carve-out acquisition, carving out from a larger business. It could be, a UPS store where one owner owns 10 locations and they're selling 2 of them. And you need to carve out those 2 locations and see what it would look like and how would the business cash flow with just those 2 locations. And the problem is that a lot of times sellers don't have bookkeeping done for each individual store. And even if they did, there would still be some challenges because when you have multiple locations, you're probably sharing some expenses across those locations or those divisions or those territories. So you might have a regional manager and they have an expense associated with that regional manager, but it's spread out across, if they're paid $100,000, it's spread out across 10 locations. Each location should have $10,000 worth of expense, right? But then is that regional manager going to stick around with the new buyer coming in, or is the buyer going to take that role? And so there's just lots of questions about what do the new kind of projected financials look like for this carve-out acquisition. What I want to do here is I've got a spreadsheet here that kind of demonstrates what you need to be able to show a lender and kind of demonstrates the analysis that they're going to do. And so whether you're the buyer or the seller, this is the kind of work that you're going to have to kind of pull together in the notes and the documentation assumptions that you need to kind of use to back up your projected financials of the carve-out. Okay, so in this example, I'm going to say, let's assume this is a 4-location retail chain and the buyer is looking to purchase location number 3. Okay. And so what you start with in this column B is the combined tax return. It's a tax return for all 4 stores. Okay. And so you can see here, what that looks like. There's kind of this recast cash flow, right? So overall, that business is doing across the 4 locations, $231,000 in seller's discretionary earnings, let's say. Okay. Now, the carve-out location is just location 3. So location 3 does 1.26 million revenue. You can see their margins are similar to the total. They've got rent for that specific location, payroll and whatnot, right? So we can kind of go down the list and we can see what their net income is and then add back. So we're going to add back depreciation. We're going to add back some HVAC repair that was a one-time expense. So that gives us a adjusted net income or EBITDA for just that one location. Now the question is, how much of a loan can that service? How much debt can that service? So in this case, what we're saying here is the proposed SBA loan amount is $300,000 for this location. The cash flow is $60,800. The estimated annual debt service is $50,000. That gives them a 1.2 debt service coverage ratio. The SBA minimum is 1.15. So I guess we say this deal should comfortably clear it. It's not comfortable. It barely meets the mark, but this 1.2 debt service coverage ratio is what we need to be able to calculate for the standalone or the carve-out entity. That's what the lender is going to be doing. And they're going to want to analyze and make sure that what percentage of the total is the carve-out. So right here, what we're doing is we're taking the carve-out revenue, location 3 revenue divided by total revenue, and it represents 26.3% of revenue. So that kind of makes sense, right? It's 1/4 of the locations and it's roughly 1/4 of the revenue. And we can back that up by the point of sale system, right? So we're making notes over here for the underwriter or rationale for any variances. On the merchandise purchases, here we're seeing 26.8%. Again, that makes sense, right? Because it's about a quarter of the total. As we move down to expenses, so this 28%, that's a little higher than 25% that we would expect. So we have some notes here. Carve-out rent is higher than pro rata. Variance is supported by actual lease agreement. So, okay, we've got a lease agreement. So that's just what it is, right? We can go on, insurance, telephone and internet, 30% of combined because Carve-out has dedicated point of sale security circuits. Seller's headquarter phone system stays with remaining business. This case, this tracks with proportionally with revenue, no adjustment needed. You can go on here. See, here we show that this was 50% right here. This repairs and maintenance total was $36,000. This Carve-out location was $18,000. So that's 50% of the total. So that kind of sticks out as something weird, right? So here we said the Carve-out had an HVAC replacement in the trailing 12 months. It was a one-time expense of $9,000, and we expect recurring repairs and maintenance to go back to $9,000 going forward. And so when we look at our add back down here, we see an add back for a one-time HVAC repair down here for half of that cost. These are the types of things that you're going to need to do and document, show to a lender. And the more detail you can provide, the better. There's going to be situations where you are, so like this, corporate headquarter overhead, owners, auto and travel, owners compensation, right? So these are all expenses that are just going to completely go away, right? The new Carve-out is not going to be paying the former owner anything. They're not going to be paying for their vehicle. They're not going to be paying for corporate overhead because the new owner is going to take care of that, right? And so, and also the owner here, the owner may make. Also here, as we look at the store payroll for the manager. So one question as we look through this could be the buyer. How are they going to get paid? Well, maybe in this case, the buyer is the manager here. So let's say the buyer's going to be the manager. They're already getting paid $65,000 and they're living on that, right? So they're just going to keep that salary, but they're going to now buy this location from their employer and own it. So we don't need any additional owner's compensation. If you did need, now if you're the buyer and you needed to pay yourself, $65,000, let's say, and you needed to keep this manager, well, that's going to eat up a lot of or all of your cash flow effectively, right? So then you'd have no cash flow available for debt service and you wouldn't be able to make this work. So this is the kind of process you need to go through. This is something that we help clients do both on the seller side. So if you're selling a portion of a business and you just want to get prepared, how do I get my financials into a format that are going to, pass muster with the SBA underwriter or any sort of lender? That's something we can help with here at ProjectionHub. And if you're a buyer and you're saying, okay, I want to buy a portion of this business, one location, one territory of a franchise, one division of a business, something like that, we can help you get the financials into the right format that's going to help you kind of document that for what an SBA lender is going to be looking for. I guess I never mentioned, but my background, I was an SBA lender for 12 years, close to about 1,500 SBA loans. And now I own ProjectionHub. And this is the kind of work that we do, helping folks to secure SBA loans for acquisitions and help through the projection and business planning process. And this is something, this Carve-out Acquisition is something that I think we're uniquely qualified to do because we really specialize in projections, and carve-outs require projections, and they need to be based on clear written assumptions. And we can help you document that and get that in that, underwriter approved format and rationale there. So if you have any questions or you want to reach out and just have a conversation about your particular situation, feel free to reach out at support@projectionhub.com. And we'd love to help you. And if you found this video to be helpful, just understanding the process, I'd really love it if you like the video and subscribe. We're going to be putting out more content for both buyers and sellers, particularly folks looking to use the SBA, an SBA loan to close a deal. So we hope that's been helpful. Thanks.